At the age of 25, Warren Buffett founded his first investment enterprise. This investment business, which he titled Buffett Partnership, operated from 1957 through 1969 and had an average return of 29%. The amazing thing about Warren Buffett's investment strategy is that he employs fairly basic strategies to earn such large returns. Welcome to Finance Dojo. We aim to be the best personal finance educational channel you'll ever need. Click that subscribe button and the notification bell right now so you won't miss out. As Warren Buffett says, you don't have to be a rocket scientist to achieve this. Investing is not a game where the person with a 160 IQ wins over the person with a 130 IQ. Rationality is essential. The key to getting high returns is to stay sensible and adhere to uncomplicated solutions even when things get challenging. In this video, I'd want to teach you 7 investing guidelines that Warren Buffett utilized to help him reach such a high return, but I'm not promising that you'll be able to match Buffett's performance. However, following these 7 investing guidelines from Warren Buffett can significantly improve your long-term return on investment. He has committed his life to investing, and he's a very intelligent man. Rule number 1. If a business does well, the stock will eventually follow. When Warren Buffett first picked up one of the finest investment books of all time, he learned this rule. Benjamin Graham, who eventually became Warren Buffett's mentor, wrote The Intelligent Investor. One of the ideas presented in the book convinces Buffett that when you own a stock, you own a piece of a business, and that if their firm does well over time, the stock will do as well. So search for firms with a high profit margin that is likely to dominate in the future. Once they have gotten ahead of the competition, their customers love them. You don't need a complicated guy's stock as part of the business. If their firm succeeds, you will succeed as well. Rule number 2. The vast majority of news is noise, not news. Buffett may hold a controversial stance, but much of the news you read is unnecessary when it comes to investing. The fact is, news organizations such as CNBC, news websites, and financial YouTubers are all compensated to acquire as many views as possible. They accomplish this by creating as much excitement or tension as possible, as well as much news as possible to attract those views and so earn more money. As Buffett points out, only around 5% of the news is worth paying attention to. Owners of stocks too frequently let their fellow owners' unpredictable and often irrational behavior to cause them to act impulsively as well. Because there is so much talk about markets, the economy, interest rates, stock price behavior, and so on, some investors think it is necessary to listen to experts and worse, to contemplate acting on their comment. Don't bother about the pundits or the majority of the news. Just pay attention to the vital aspects. Rule number 3. When you buy a stock, plan to hold it forever. I'm hoping you've been taught this financial theory previously. When you receive dividends or capital gains and allow them to compound and build like a snowball, you may make a lot of money. However, if you're continuously buying and selling stocks, you're not allowing compound interest to work for you, and you'll miss out on a lot of profits. It's all about the time in the markets, not timing the markets, they argue. The key to investing is to acquire a company to own it for the rest of your life, which is why Warren Buffett has held Coca-Cola, Wells Fargo, and American Express for over 25 years. If the job is done well when a common stock is purchased, the time to sell is rarely, says the Grateful Fisher. Rule number 4. Only pay attention to those you know and trust. The wonderful thing about investing is that you are not alone. Even Warren Buffett has spent his whole investment career learning from and listening to other investors. When he was younger, he had Benjamin Graham as an investment mentor who taught him the ropes. And as he grew older, he always had Charlie Munger by his side to check whether he was on the correct track. We're fortunate in that we have excellent investors to listen to and learn from. we can examine the precise equities that Warren Buffett buys each year, as well as his total portfolio. Ray Dalio, like Charlie Munger, is frequently on CNBC, voicing his opinions on many topics. But the important matter is to listen to people we know and trust. Do we have to listen to that CNBC commentator who is always spouting off about the newest hype? Or the new YouTuber with a lot of views preaching about Tesla stock ownership? Do they know how to invest? Do they truly comprehend each stock's inherent value? Only those you know and trust should listen. Rule number 5. Know what you're getting into before you invest. Risk is what comes when you don't know what you're doing. Understanding the firm you're investing in is a pretty easy guideline that not many people follow. When we look at Warren Buffett's portfolio, we can see that many of the firms he owns are rather straightforward. Coca-Cola is a firm that's starting off selling soft drinks but has now evolved into include meals. There is an aircraft firm called Southwest Airlines that makes money by selling flights. They offer furniture at Furniture Mart. They offer iPhones and other gadgets at Apple. Before buying a stock, Warren Buffett makes certain that he understands the firm, and you should do the same. Look into Ford, Toyota, and Tesla if you're into autos. If you're interested in e-commerce, check out Amazon and Alibaba. Look at firms like Alphabet, which owns Google and YouTube, if you enjoy the internet world. There are stocks available for almost any hobby or interest, but only those firms that you can comprehend should be purchased. Rule number 6. Be afraid of others who are greedy, and greedy when others are afraid. This is a guideline that is especially applicable in today's economy. The difficulty with the present market conditions is that we've been in a bull market for about 11 years. Stocks have increased by more than 300%. When it comes to the stock market, everyone believes they're geniuses because everything is going up and everyone is making money. This leads to one apparent result. Everyone gets greedy as a result of their overconfidence and investment abilities. What effect do you believe this will have on stock prices? Everyone wants to invest, but as stock prices rise, it becomes increasingly difficult to locate a good deal in the stock market. These are the times when we need to be frightened and cautious with our investments, and this is precisely what Buffett is doing. He has $214 billion in publicly listed equities and $128 billion in cash, which is a lot of money in cash. In present market conditions, he's taking a cautious approach. You might argue he's been frightened, but you can bet on your bottom dollar that as soon as the stock market panics, Warren Buffett's greed will kick in and he'll be buying up a lot of stocks when they're on sale. Rule number 7. Purchase at a price to intrinsic value. When it comes to investing, if you don't follow this rule, all of your other rules will be thrown out the window and your investment plan would be meaningless. No matter how excellent the firm is, how competent the managers are, or how well you understand the organization, it is not worth an infinite price. Therefore, make sure the amount you are paying is below or at intrinsic value. Let's pretend you're considering purchasing a Lamborghini. There is no doubt in anyone's mind that this is a high-quality vehicle. There's no doubt that the designers took great care and accuracy while creating this vehicle. But the real issue is whether it's worth the price tag. Is it worth $350,000? Remember that no automobile is worth an unlimited amount of money, and a business flash stock is no different. Which is why Warren Buffett says, no company, no matter how great, is worth an infinite amount of money. What you pay is what you get. What you receive is value. To determine the intrinsic value of any stock, you must first understand how to calculate it. Nonetheless, these 7 guidelines are crucial when it comes to investing, in my opinion. As always, this video is for educational purposes only and not financial advice. You should always do your own research and speak to a financial advisor before making any investment decisions. Thank you for watching and see you in the next one.